How the stock market actually works. The stock market often looks chaotic from the outside. Prices move every second, numbers flash in red and green. Millions of orders are executed instantly, and beginners feel as if a mysterious force controls everything. But once you understand how the market truly works, you will realize that every price movement has a logic. The market behaves like a living ecosystem with rules, players, psychology, and patterns. This chapter reveals who controls the market, how prices actually move, how orders get executed, why institutions dominate, what makes market rise and fall, and why retail traders often stand on the losing side. The real participants of the stock market. The market is not controlled by a few traders sitting in a room. It is a battlefield of different types of players, each with different goals and powers. Let's break down the major participants. First is retail traders, the common public. These are people like you and me, using mobile apps, trading small quantities, influenced by news, tips, emotions. They create noise, not direction. Retail traders account for the largest number of trades but the smallest money in the market. Second is institutional investors. These are the real giants: hedge funds, mutual funds, pension funds, banks, insurance companies. They control 70 to 90% of the total volume in most markets because they buy and sell in huge quantities. They often dictate market directions. Third is market makers. Market makers ensure liquidity. Their job is simple: always offer buy and sell prices, match buyers with sellers, reduce volatility, stabilize the market. They are the invisible breeze that makes trading smooth. Fourth is foreign institutional investors and domestic institutional investors. Foreign institutional investors bring global money into the market. Domestic institutional investors include Indian mutual funds, banks, and insurance companies. When foreign institutional investors buy heavily, market rises. When foreign institutional investors sell, market falls. Their flow acts like a heartbeat of the market. Fifth is algorithms and high frequency traders. These are ultra fast computers that trade in milliseconds. Their features: no emotion, data driven decisions, lightning speed, scalp micro inefficiencies, create up to 60% of intraday volume. When beginners say market is manipulated, the real cause is usually algorithms, not humans. How price actually moves. Most people believe good news implies prices goes up, bad news implies prices goes down. This is false. Price moves because of demand and supply, created mostly by institutions. If more people want to buy, prices rise. If more people want to sell, prices fall. But here is the important part: demand and supply are not natural. Institutions create demand, institutions remove supply. That's why price doesn't move in a straight line. The matching engine: how a trade is completed. Every exchange has a machine called a matching engine. Here is how it works. You place a buy order at rupees 100. Someone else places a order sell order at rupees 100. The exchange matches both. A trade is completed. This happens millions of times per second. Everything from your order to execution takes microsecond. The real reason prices move every second. Prices moves every second because millions of orders keep coming. Institutions adjust their positions. Algorithms respond automatically. Traders execute intraday strategies. Global markets affect sentiment. Think of the market like a river, constantly flowing, never still, always reacting, always evolving. Why institutions dominate the market? Institutions have three things retail traders do not. First is massive capital. Retail traders buy 100 shares, institutions buy 10 lakh shares. Big order is equal to big market impact. Advanced technology: institutions have AI models, supercomputers, high frequency systems, real time data. Indicators unavailable to retail. You cannot beat them in speed, you beat them in strategy. Third is professional analyst. Teams of economists, data scientists, chartered analysts, risk managers, psychologists. Retail traders rely on YouTube videos. Institutions rely on research worth crore. Why news does not move the market? Beginners believe that news controls everything, but institutions already know the news before the public. What actually happens? Prices rise implies then good news is shown. Prices drop, then bad news is shown. This is reverse logic. Institutions use news as a tool to create fear, panic, excitement, traps. News rarely causes the movement, it mostly justifies the movement. How market cycles are created? Market cycles are created by smart money in three phases. First is accumulation. Institution buy silently at low prices, retail ignores the stock. Second is manipulation. Fake breakouts, news, rumors, retail enters emotionally. Third is distribution. Institutions sell gradually at high prices, retail gets trapped at the top. This cycle repeats forever. Why retail traders often lose? Retail traders lose mainly because they follow emotions, they follow rumors and tips, they chase momentum too late, they exit early in fear. They lack a strategy. They trade without risk management. They think they can predict the market. While institutions follow data, control liquidity, manipulate price zones, trap emotional traders. The market is not random, it is simply the place where smart money wins and emotional money. Chapter 2 summary. The stock market is not controlled by luck, it is controlled by logic, liquidity, and large players. Institutions move the price, not news. Retail traders lose, but not because the market is unfair, but because they do not understand how the system works. If you learn the mechanics of the market, you stop guessing and start winning.